Credit Suisse did not collapse in a single weekend. It deteriorated over years. Scandal after scandal, risk failure after risk failure. Capital raised, confidence reassured, then confidence questioned again. The bank survived the financial crisis. It survived restructurings. It survived leadership changes. But it did not survive the erosion of trust. In March 2023, deposit outflows accelerated. Liquidity support was announced. Markets did not stabilize. Within days, a 167-year-old institution was forced into a government-backed merger. This was not a sudden collapse. It was cumulative governance failure reaching its structural limit.
Credit Suisse did not collapse in a single weekend. It deteriorated over years, scandal after scandal, risk failure after risk failure. Capital raised, confidence reassured, then confidence questioned again. The bank survived the financial crisis. It survived restructurings. It survived leadership changes, but it did not survive the erosion of trust. In March 2023, deposit outflows accelerated. Liquidity support was announced. Markets did not stabilize. Within days, a 167-year-old institution was forced into a government-backed merger. This was not a sudden collapse. It was cumulative governance failure reaching its structural limit.
Credit Suisse was founded in 1856 to finance Swiss rail infrastructure. It was built to support industrial expansion. Over time, it evolved into a global financial institution. By the late 20th century, it operated across investment banking and wealth management. Its private banking franchise became central to its identity. Swiss banking secrecy strengthened its global appeal. High net worth clients viewed the institution as discreet and stable. The brand became associated with preservation of capital. Zurich served as the symbolic center of that stability. Glass towers reflected institutional permanence. The bank expanded across Europe, the United States, and Asia. Its balance sheet grew through cycles of growth and contraction. During the 2008 financial crisis, it absorbed significant stress, yet it avoided the scale of failure seen elsewhere. Capital buffers were reinforced in the years that followed. Regulators tightened oversight across European banking. Credit Suisse adapted within that environment. It restructured certain trading operations. It reduced selected risk exposures. It emphasized wealth management expansion. The wealth unit generated consistent fee income. Advisory services deepened client relationships. Assets under management became a core metric. Market positioning focused on global affluent clients. The franchise narrative emphasized resilience. Investor presentations reinforced long-term stability. Annual reports highlighted diversified revenue streams. Risk disclosures expanded in length. Capital ratios were communicated with precision. Management described the institution as systemically important. Swiss regulatory alignment reinforced confidence. The brand carried 167 years of operational continuity. Institutional clients relied on its clearing and custody functions. Corporate advisory mandates sustained investment banking relevance. Board governance structures appeared formally robust. Risk committees operated within defined frameworks. Internal controls were documented extensively. External audits affirmed regulatory compliance. Supervisory bodies maintained ongoing dialogue. From the outside, the structure appeared durable. From the inside, complexity had increased materially. Global operations created interlinked risk channels. Revenue volatility persisted beneath surface stability. Capital strength depended on sustained confidence. Client trust remained the franchise foundation. Brand equity substituted for visible fragility. The institution functioned because confidence held. Structural takeaway: a franchise can appear stable while internal complexity accumulates beneath it.
Credit Suisse partnered with Greensill Capital to create supply chain finance funds. These funds purchased receivables originated by Greensill.
The structure promised low volatility income. Investors were told exposures were short-term and diversified. The funds grew rapidly within wealth management channels. Client capital flowed into the strategy. Marketing materials emphasized conservative risk positioning. Underlying assets were concentrated in specific counterparties. Some receivables depended on future projected revenues. Insurance policies were used to enhance perceived safety. Risk assessments relied partly on external coverage. When insurance protections weakened, structural fragility increased. In 2021, Greensill Capital entered distress. Credit Suisse suspended several supply chain finance funds. Approximately $10 billion in client assets were frozen. Investors faced uncertainty over recovery. Internal reviews examined due diligence standards. Questions emerged about counterparty concentration. Documentation revealed complexity in receivable structures. Valuation clarity diminished. Clients questioned disclosure transparency. Media scrutiny intensified across European markets. Regulators requested detailed explanations. The event damaged wealth management credibility. The franchise promise of capital preservation was challenged. Legal exposure increased through potential client claims. Recovery efforts required asset liquidation strategies. Trust erosion began within private banking relationships. Relationship managers faced client withdrawals. Internal risk committees reassessed exposure oversight. Operational resources shifted toward remediation. Leadership communications emphasized containment. However, reputational impact extended beyond financial loss. Confidence is cumulative and path-dependent. The Greensill episode signaled governance weakness. The issue was not only loss magnitude, it was control failure within a core client segment. Wealth management relies on perceived prudence. Fund suspensions contradict stability narratives. Capital markets observed structural vulnerability. Credit spreads reflected rising uncertainty. Equity valuation declined. Funding costs increased marginally. The institution remained solvent, but confidence metrics deteriorated measurably. Structural takeaway. Exposure concentration within trusted products can destabilize the core franchise when oversight fails.
Archegos Capital Management operated as a family office using high leverage. It built large equity positions through derivatives. Prime brokers financed these exposures through margin arrangements. Credit Suisse was one of the largest counterparties. Risk controls depended on margin discipline and collateral monitoring. Client relationships influenced tolerance for exposure growth. Positions were concentrated in a limited set of stocks. Market liquidity assumptions understated exit difficulty. In early 2021, price declines triggered margin calls. Some counterparties reduced exposure rapidly. Credit Suisse response was slower and more fragmented. Internal coordination across desks was limited. Decision rights were distributed across committees. As prices continued falling, collateral became insufficient. Forced liquidation followed across the market. Credit Suisse incurred losses of approximately $5 billion. The loss was one of the largest in its history. It erased a full year of expected profit capacity. Risk reports documented prior warnings. Red flags had been identified and discussed, but corrective action did not match risk accumulation speed. Governance failed at execution. Control functions lacked operational authority to halt exposure. The event triggered senior management departures. Resignations signaled accountability pressure. Regulators demanded detailed failure analysis. Public reports described multiple control breakdowns. Counterparty risk processes were reassessed. Prime brokerage strategy was reduced. Capital was redirected to rebuild buffers. Investor confidence declined further. Credit ratings were placed under review. Funding markets priced higher uncertainty. Clients in wealth management noted instability. The Archegos loss damaged institutional credibility.
It reinforced the perception of weak risk culture. It also created future litigation exposure. Operational costs increased through remediation programs. Strategic plans were revised again. Each revision reduced the credibility of prior guidance. The bank remained operational, but the market treated the franchise as deteriorating. Confidence declined through repeated discrete events. The system absorbed shocks until trust limits were reached. Structural takeaway. Large single counterparty losses occur when governance cannot enforce margin discipline against relationship incentives.
Following successive losses, capital adequacy became a central focus. Regulatory minimums remained technically satisfied. However, market confidence required excess buffers. Credit Suisse announced multiple capital raises. New equity issuance diluted existing shareholders. Each raise was framed as strategic reinforcement. Investors were told the balance sheet would stabilize. Subscription commitments were secured from anchor investors. Market reaction was measured but cautious. Share price volatility persisted. Dilution reduced earnings per share expectations. Return on equity projections were revised downward. Capital strength improved numerically, but franchise perception did not fully recover. Repeated capital injections signaled underlying weakness. Investors questioned sustainability of the model. Cost reduction programs were expanded. Asset sales were explored. Investment banking footprint was reduced selectively. Risk-weighted assets were recalibrated. Liquidity coverage ratios were emphasized in disclosures, yet funding spreads widened incrementally. Credit default swap pricing reflected elevated risk. Equity valuation declined relative to peers. Strategic transformation plans were presented again. Each plan promised simplification. Each plan acknowledged prior missteps. Execution timelines extended. Analyst reports grew more skeptical. Institutional shareholders reduced exposure. Confidence erosion accelerated through dilution cycles. Capital raising became reactive rather than proactive. The market interpreted actions as defensive. Balance sheet resilience depends on trust. Numerical compliance is not equivalent to credibility. The bank remained operationally solvent, but equity markets priced structural uncertainty. Raising capital preserves liquidity. It does not automatically restore reputation. Repeated dilution changes ownership structure. Governance influence shifts with new shareholders. Long-term investors reassessed commitment. The institution functioned under increasing market discount. Structural takeaway. Repeated capital raises can stabilize ratios while simultaneously weakening market confidence.
Leadership turnover increased following successive control failures. Chief executive changes signaled instability at the top. Board transitions followed major loss events. Strategic direction shifted with each appointment. Transformation programs were introduced and revised. Executives emphasized cultural reset. Risk management restructuring was announced repeatedly. However, continuity of execution weakened. Internal morale declined within key divisions. Senior talent departures accelerated. Recruitment efforts sought external credibility. Compensation frameworks were adjusted to retain staff. Organizational charts changed frequently. Reporting lines were redrawn. Accountability structures evolved across quarters. Public messaging emphasized decisive leadership. Investor calls referenced renewed discipline. Yet outcomes lagged commitments. Strategic consistency requires stable governance. Frequent leadership change disrupts institutional memory. Long-term plans require sustained oversight. Board oversight relied on updated management assurances. Regulators increased supervisory engagement. External stakeholders questioned succession planning. Media narratives focused on executive exits. Confidence is partly relational. Wealth management clients monitor leadership signals. Institutional investors assess executive credibility.
Strategic pivots created execution fatigue. Internal control enhancements required consistent enforcement. Cultural transformation depends on repetition. Short tenures limit behavioral alignment. Executive reshuffles signaled reactive governance. The market interpreted turnover as instability. Credit spreads reflected uncertainty. Shareholders reduced tolerance for further experimentation. Transformation credibility diminished. Operational continuity persisted, but narrative coherence weakened. Leadership is a stabilizing variable. When it fluctuates, confidence recalibrates. Institutional trust requires visible steadiness. Governance credibility is cumulative. Repeated resets dilute authority. The franchise entered 2023 with limited strategic runway. Structural takeaway. Persistent leadership instability undermines long-term strategic credibility even when formal governance remains intact. Reputational erosion accelerated after repeated public failures. Each event compounded prior credibility loss. Brand strength depends on consistency. Inconsistency generates cumulative doubt. Media scrutiny intensified across European markets. Analyst commentary became more guarded. Client inquiries increased in frequency. Wealth managers spent more time defending stability. Credit spreads incorporated reputational risk. Counterparties reassessed exposure thresholds. Institutional clients diversified clearing relationships. Advisory mandates shifted incrementally to competitors. Private banking inflows slowed measurably. Net new asset growth decelerated. Internal surveys reflected declining confidence. Employee retention pressures increased. Recruitment required stronger compensation incentives. Strategic messaging emphasized resilience. However, markets priced skepticism. Equity valuation remained discounted relative to peers. Ratings outlooks shifted toward negative bias. Funding costs incorporated trust premiums. Short-term liquidity remained compliant, but perception influences funding durability. Reputation is an intangible asset. It amplifies or constrains capital access. Brand deterioration limits strategic flexibility. Rebuilding trust requires time consistency. Public apologies do not restore structural confidence. Operational continuity does not erase past failures. Competitors capitalized on narrative weakness. Relationship managers encountered increased withdrawal discussions. Deposit sensitivity rose within affluent segments. Market confidence became conditional rather than assumed. The franchise narrative weakened. Investor patience shortened. Each quarter required proof of stability. Each misstep reduced benefit of doubt. Reputational decay is rarely sudden. It accumulates through repeated contradiction. By early 2023, trust reserves were limited. Structural takeaway. Reputational erosion reduces financial flexibility by increasing the cost of maintaining confidence. By early 2023, confidence had become conditional. Depositors monitored headlines closely. Wealth clients evaluated counterparty exposure. Institutional treasurers reassessed cash allocations. Outflows began gradually. Then acceleration followed negative disclosures. Liquidity buffers absorbed initial withdrawals. Public statements emphasized capital strength. However, deposit velocity increased. Private banking segments showed heightened sensitivity. Large clients transferred balances to alternative banks. Digital banking channels enabled rapid movement. Funding concentration risk surfaced. Liquidity coverage ratios were tested. Swiss regulators monitored daily flows. Management issued reassurances repeatedly. Market reaction remained unstable. Equity volatility increased further. Short sellers amplified negative momentum. Credit default swap pricing widened sharply. Counterparties tightened collateral terms. Interbank funding became more selective. Deposit attrition created signaling effects. Each withdrawal influenced additional withdrawals. Confidence functions through perception loops. Liquidity facilities were prepared internally. Emergency contingency frameworks were activated. Board meetings increased in frequency. Risk dashboards updated in real time. Swiss National Bank engagement intensified. Public communications emphasized stability. However, deposit migration continued. Private clients prioritized capital preservation. Institutional investors reduced exposure limits. Short-term liquidity remained technically compliant, but durability became uncertain. Funding markets priced escalating fragility. Analyst commentary questioned sustainability. Strategic options narrowed. The institution required external support. By mid-March, outflows accelerated sharply. Liquidity became the central variable. A bank can survive losses. It cannot survive sustained confidence withdrawal. Structural takeaway. Deposit velocity converts reputational doubt into immediate liquidity stress. As outflows accelerated, liquidity support became necessary. Swiss authorities monitored systemic implications. Credit Suisse requested access to central bank facilities. The Swiss National Bank announced liquidity assistance. Emergency lines were structured against eligible collateral. Public communication emphasized temporary stabilization. Market reaction was immediate but cautious. Equity volatility remained elevated. Credit spreads did not fully retrace. Liquidity coverage ratios improved mechanically, however confidence did not normalize. Deposit flows stabilized briefly. Then withdrawals resumed at measured pace. The backstop prevented immediate disorder. It did not restore franchise credibility. Regulators evaluated systemic risk exposure. Contingency planning intensified across Swiss authorities. International regulators observed closely. Board discussions shifted toward strategic resolution. Standalone recovery scenarios appeared constrained. Market pricing reflected diminished independence probability. Potential merger discussions gained urgency. Liquidity access bought time. Time did not restore trust. Wealth management clients assessed counterparty stability. Institutional investors questioned long-term viability. Analyst commentary shifted from restructuring to resolution. Credit Suisse remained solvent under regulatory metrics, but survival required more than liquidity. Confidence requires forward certainty. Emergency support signals structural weakness, even when facilities are precautionary. Public narratives interpreted assistance as distress. Counterparties reduced exposure further. Funding markets shortened maturities. Operational continuity was preserved. Strategic autonomy narrowed. By mid-March 2023, resolution planning accelerated. Liquidity support became bridge financing. The institution approached a structural inflection point. A bank can access central bank liquidity. It cannot compel market trust. Structural takeaway. Central bank liquidity stabilizes funding, but it cannot repair cumulative confidence erosion. By mid-March 2023, standalone recovery options were limited. Swiss authorities prioritized systemic stability. UBS emerged as the preferred acquirer. Negotiations accelerated over a compressed weekend. Government officials coordinated resolution terms. The Swiss National Bank maintained liquidity facilities. Loss absorption frameworks were structured. Shareholder value was subordinated to stability. On March 19, 2023, the merger was announced. UBS agreed to acquire Credit Suisse in an emergency transaction. The deal reflected government-backed intervention. Additional loss guarantees were arranged. Liquidity assistance remained available. AT1 bondholders faced full write-down. Equity holders incurred substantial dilution. The merger price reflected distressed conditions. Market reaction was controlled but definitive. The 167-year-old institution ceased independent existence. Operational integration planning began immediately. Regulators emphasized continuity of services. Systemic risk was contained domestically. International markets monitored spillover. Depositors were protected. Client accounts remained accessible. Trading operations continued under supervision. Resolution mechanisms functioned as designed. Swiss authorities framed the action as preventative. The objective was to prevent disorderly failure. UBS assumed selected assets and liabilities. Risk transfer was structured carefully. Cost synergies were projected. Cultural integration posed future challenges. Brand identity of Credit Suisse was phased out. The franchise legacy transitioned to UBS control. Employees faced uncertainty under new governance. Global offices prepared for consolidation. Markets adjusted to a consolidated Swiss banking sector. The transaction closed a prolonged erosion cycle. The collapse was administrative rather than chaotic. Liquidity pressure converted into resolution. Governance failure culminated in acquisition. The bank did not fail overnight. It exhausted structural tolerance. March 19th marked the endpoint of cumulative stress. Corporate history transitioned into integration phase. Structural takeaway. Resolution through merger preserves systemic stability while terminating institutional independence.
Credit Suisse did not fail because of a single event. It weakened through accumulated governance lapses. Each scandal reduced internal credibility. Each loss reduced external tolerance. Capital adequacy alone did not secure stability. Liquidity access alone did not restore trust. Reputation proved to be the binding asset. Risk culture determines exposure discipline. Documentation without enforcement creates illusion of control. Leadership turnover interrupts strategic continuity. Capital raises can stabilize ratios while weakening confidence. Liquidity support can prevent disorder but not restore autonomy. Deposit velocity converts perception into structural stress. Markets assess patterns, not isolated data points. Repeated reassurances lose persuasive power. Regulatory compliance does not equal market confidence. Brand equity functions as a capital buffer. Once depleted, funding becomes conditional. Governance credibility compounds over time, so does governance failure. The institution remains solvent until the final phase, but solvency without trust narrows strategic options. Merger resolution preserved systemic stability. Independence was the variable sacrificed. A 167-year-old franchise ended through administrative consolidation. The collapse was procedural, not chaotic. Structural erosion preceded formal intervention. Risk accumulation was incremental. Accountability was delayed. Confidence recalibrated repeatedly downward. Stakeholders responded rationally to visible patterns. The system functioned until tolerance thresholds were crossed. Corporate history often frames collapse as sudden. In reality, it is gradual alignment of stress and weakness. Credit Suisse met accumulated stress with insufficient resilience. Governance structures existed. Enforcement discipline faltered. Liquidity facilities were accessible. Trust facilities were not. The lesson is institutional rather than episodic. Corporate collapse is rarely spontaneous. It is structure meeting accumulated stress. Confidence is the ultimate balance sheet variable. When it erodes persistently, resolution becomes inevitable. Structural takeaway. Collapse is most often the predictable endpoint of prolonged structural erosion rather than sudden failure.